Most people think wealth is made by prediction. It is not. Wealth is made by preparation. That sounds too simple, so people ignore it. They would rather believe there is a secret signal, a perfect indicator, a dramatic moment where the sky darkens, the cameras panic, the market collapses, and one brave genius presses a button that changes his bloodline forever. That story flatters the ego. It also ruins portfolios, because when real volatility arrives, most people do not behave like opportunists. They behave like civilians in a fire drill. They run, they freeze, they listen to whoever is shouting the loudest, and then 6 months later they tell themselves they were being prudent. I have never seen prudence look so much like regret right now. The market is full of people trying to decide whether chaos means danger or opportunity. The answer is yes, it means both. And that is exactly why so many people mishandle it. A war begins. Oil jumps. Commentators start foaming at the mouth about inflation, recession, geopolitical dominoes, supply shocks, and the end of the cycle. Every headline becomes a theatrical trailer for financial doom. Social media fills up with people who have not compounded $10,000 in their lives, suddenly explaining to strangers why this is the last chance to escape with their dignity. And somewhere inside that noise, the market does what it often does. It drops, then it shakes. Then it confuses everyone. Then it recovers faster than the average fearful person thinks it should. Not because the world is stable, because markets are forward-looking machines, and fear always gets priced faster than clarity. That is the first thing you must understand if you want to build serious wealth. The market is not asking whether the world feels scary. The market is asking whether the scary thing is already in the price. Most people never learn the difference. They stare at the event and ignore the discount. That is how the crowd keeps donating opportunity to anyone with a longer attention span. I have spent enough years around markets to notice something that is both obvious and repeatedly forgotten. Bad headlines are common. Permanent destruction of productive enterprises, rare wars, crises, banking scares, oil spikes, pandemics, elections, policy mistakes, political theater, tariff tantrums, all of it passes through the machine. Every one of these events feels unique when you are standing in it. Every one of them arrives with experts insisting this time the old rules no longer apply. And yet, over and over, the same blunt fact keeps surviving the theater. The market rewards ownership over time. That is not ideology. That is history. People hear a sentence like that and accuse you of being simplistic. They think complexity sounds more intelligent. But complexity is often what frightened people use when they want to avoid doing the one thing that has actually worked for generations, which is owning good businesses or broad productive assets long enough for panic to decay. This is not a small point. It is the whole point. You can lose a fortune trying to be clever around a trend that would have made you rich if you had simply behaved. And that is where the current setup matters so much. Because when fear is high and headlines are loud, people imagine the opportunity is in being right about what comes next this week. It is not. The opportunity is in understanding what this kind of volatility has historically done to the price of future returns. When war begins, uncertainty rises. Markets hate uncertainty, so prices wobble. That part is easy. What is harder for people to accept is that uncertainty itself often becomes the mechanism that creates the next great buying zone. Not because war is good, not because pain is profitable in some moral sense, because when human beings get scared, they misprice duration, they sell 10-year cash flows because they cannot emotionally survive 10 days of noise. That is a gift, if you are prepared. Notice I did not say if you are brave. I said if you are prepared. Bravery is overrated in markets. Preparedness matters much more. A prepared investor does not need nerves of steel. He needs a plan he can still execute when the mood gets ugly. And that is the part most people miss. They think making generational wealth in a volatile year is about being aggressive. Usually it is about being structured. A man with no cash, no framework, no watch list, no position sizing discipline, and no idea what he owns cannot exploit a drawdown. He can only experience it. A man who has already decided what to buy, how much to buy, under what conditions to buy, and how he will respond if the market gets worse can convert the same drawdown into something else entirely. He can convert it into inventory. That is what the crowd never sees. They see a falling market and think loss. The prepared investor sees inventory getting marked down. This does not mean you buy blindly. That is the second error. The first error is panic selling. The second is romantic dip buying. A lot of people heard somewhere that you are supposed to buy fear. So now every time the market falls 3%, they try to play hero with money they do not truly have allocated for the job. That is not investing. That is emotional gambling with a bullish vocabulary. If you go all in the first time the market twitches lower, what happens when it falls much further? You do not have a strategy, you have a slogan, and slogans do not deploy capital. Well, you need levels, you need patience, you need the humility to understand that a market can always get cheaper in the short term even while becoming more attractive in the long term. Those two facts coexist all the time. This is why I have always preferred systems to declarations. A declaration says the bottom is in. A system says if the market is here, I buy this much. If it falls more, I buy more. If it falls even further, I buy again. And if it keeps falling, I still have emotional and financial room to keep acting, because I planned for the possibility before the first drop happened. That is what wealthy investors do when the world looks unstable. They do not guess. They prepare. Now, let us deal with the fear that keeps getting dragged onto the stage during periods like this, which is oil. Whenever oil jumps, people start talking as if the whole economy is about to choke on the spot price of a barrel. They tell themselves we are going back to the 1970s stagflation. Permanent inflation spiral. Consumer collapse, market implosion. It is the same lazy narrative every time because it feels intelligent to connect visible energy stress to broader economic fear. The problem is that many people misunderstand the chain. Oil can create price pressure, oil can hurt, oil can weaken margins, compress demand, and feed uncertainty. But oil by itself is not some mystical inflation machine that rewrites the entire economic order forever. Commodity spikes are cyclical. Demand responds, supply responds, substitution happens, politics intervenes, profit incentives wake sleeping capacity. The fever eventually forces its own enemy into existence. This is one reason I dislike dramatic oil narratives as portfolio strategy. They take a temporary pressure point and market it like a permanent worldview. I have watched this happen over and over. Oil spikes. People panic. Everyone starts explaining why everything will be worse for much longer than is economically tolerable. Then the spike fades, prices normalize, and the same people simply move on to the next fear without apologizing for the damage they did to other people. Decision making. If you want to build wealth, you cannot let your capital become an emotional hostage to every commodity move. That does not mean ignoring it. It means classifying it properly. Temporary shocks can create great buying conditions if the underlying businesses you own will still be stronger and more profitable 10 years from now. That is the key horizon, 10 years. I know that sounds slow to people trained by apps, feeds, and dopamine charts. They want wealth to happen in 3 candles and a screenshot. But markets do not care what kind of attention span culture has trained into you. They reward duration. If you study long market history, one brutal fact emerges again and again. Bull markets are longer, stronger, and far more profitable than bear markets are destructive, provided you survive them correctly. Bad years happen, lost years happen, even ugly clusters happen. But when you zoom out, the long upward bias of productive enterprise in a growing economy overwhelms the episodic collapses that feel so terminal in the moment. That is why I always tell people that time horizon is not just a planning detail. It is a weapon. The shorter your horizon, the more the market can punish you for being right too early, wrong too late, or emotional at the wrong moment. The longer your horizon, the more panic becomes your supplier rather than your enemy. People love quoting Peter Lynch, but most of them quote him like they are reciting scripture rather than obeying it. He said more money has been lost preparing for corrections than in the corrections themselves. People nod, smile, repost it, and then the next time the market shakes, they do exactly what the quote warned them not to do. That is because the quote is not hard to understand. It is hard to live. Living it means accepting that fear will often feel logical right before it becomes expensive. It means accepting that the market does not give you a certificate saying the correction is over. It means accepting that your emotions will lag the opportunity. And it means accepting that your success will probably come from doing something very boring while everyone around you is desperate to do something dramatic. This is also why I think the 10-year frame is so powerful. Not because it is magical, because it sits in a sweet spot between practicality and statistical strength. Day trading is a knife fight. Swing trading feels sophisticated but still leaves you exposed to moods, errors, and timing luck. Over 10 years, the market's historical success rate becomes so overwhelmingly tilted in your favor that the game changes. You are no longer asking whether you can outmaneuver the next few months. You are asking whether you can simply stay attached to a good vehicle long enough for the engine of capitalism to do what it does. That is a much better game. And if you can see that, then the current moment looks very different. A lot of people look at war, oil, and volatility and think this is the beginning of disorder. Maybe I look at the same setup and think this is the kind of environment that hands long. Term investors temporary discounts while convincing weak hands those discounts are fatal. That is a different lens. Now let me sharpen it. The easiest way to exploit this kind of setup is not through heroic stock picking. It is through broad market exposure. If you own a broad ETF tied to the large productive engine of the market, the beauty is that the garbage gets removed over time and the future leaders replace it. Sears falls out, something stronger comes in, weak companies die, new winners rise. The index metabolizes failure for you. That is an enormous advantage for people who want the upside of capitalism without having to be a full-time detective. So when volatility rises, broad market buying becomes the first and most obvious operating system. Keep buying, keep some dry powder, increase your buying when the discount gets larger. Do not try to prove to anyone that you found the exact bottom. That is ego work. Not capital work, but broad market exposure is not the whole story for everyone. Some people want concentrated upside. That is where the conversation becomes dangerous. Because now discipline matters more than intelligence. Picking a great company is not enough. You also need the psychological structure to sit through what a great company can look like in a bad year. A true long-term winner can still get cut in half or worse. During moments of fear or repricing or temporary narrative collapse, if you do not have conviction, process, and emotional stability, you will turn a good pick into a bad result by abandoning it at exactly the wrong moment. This is why individual stocks are so unforgiving. You need good judgment at entry and good behavior afterward. Most people can occasionally guess, right? Very few can keep behaving correctly. Once a position is down 40%, the media hates it, and their friends are sending them messages asking if they are okay. That is why broad ETFs remain the honest answer for most people seeking serious wealth. They protect you from your own need to be right in public. Now let me turn to another important point people miss during wars and major crises. Not all volatility is created equal. There is volatility that reflects deteriorating long-term value, and there is volatility that reflects emotional repricing of uncertainty. Those are not the same. If a business model is broken, a balance sheet is collapsing, or a technology is being structurally displaced, a lower price may simply be the beginning of reality catching up. But if a good business is getting sold because the whole market is frightened about macro inputs, it will likely outgrow over the next decade. That is different. That is where wealth gets transferred from impatient people to prepared people. This is why quality matters so much. Cheap junk is not opportunity. It is junk on sale. But strong businesses marked down by temporary fear can be one of the best trades life ever offers you, provided you have the patience and the emotional silence to hold them through the storm. That is also where people get confused about taking profits. I am not against taking profits. I am against using fear as the excuse for risk management you should have been practicing. Anyway, if a position is up 100%, 150%, 200%, trimming some of it can make sense regardless of the geopolitical backdrop. That is not bearishness. That is maintenance. You lighten the pigs a little, you keep the quality, you restore balance. But what you do not do is liquidate your entire future, because the world is once again temporarily reminding you that history is noisy. History is always noisy. The long-term chart is made of noise that somebody survived. That is what people forget. They see each crisis as unique because they are standing inside it. When you zoom out, what you often see is that the market keeps converting crisis after crisis into another section of the staircase. Upward, that staircase does not rise in a straight line. That is why it keeps fooling people. A straight line would be easy. A staircase with traps, drops, war headlines, inflation scares, oil spikes, and recession chatter is difficult enough to keep the impatient underperforming. The friction is the feature. Markets have to feel difficult or there would be no premium for enduring them. That is what generational wealth really is in many cases, not genius endured ownership. Now let me tell you what not to do. Do not go all in because a video told you fear is good. Do not abandon your plan because a chart looks scary. Do not confuse a bear thesis with a time machine. Do not build your investment life around guessing whether tomorrow will be green. Do not buy individual names just because somebody with confidence and a microphone said the next 10 years belong to them. And do not sit in cash waiting for the market to apologize before you re-enter. The market does not apologize, it moves. Usually before you feel ready, if you want to exploit a setup like this one. Here is the operating system. Own a core of broad productive assets. Keep a reserve of deployable capital, but not so much that you turn optionality into paralysis. Buy in stages, not speeches. Increase conviction only where quality justifies it. If you play with individual names, play small enough that volatility does not break your behavior. Trim excess risk when positions become fat, but do not confuse trimming with fleeing. And above all, stretch your horizon long enough that today as fear becomes a cheap chapter instead of your whole story. That is how generational wealth is actually built in moments like this. Not by predicting the war, not by forecasting the exact price of oil, not by timing the first 10% rally after the first 12% drawdown, by recognizing that volatility, when attached to productive assets and handled with preparation, can become one of the most generous sellers you will ever meet. It will not feel generous, it will feel dangerous. That is the trick. Danger is how opportunity dresses when it wants weak hands to leave the room. The investor who understands that does not need to be the smartest person in the market. He just needs to be the one who prepared before the discount arrived. That is why I say preparation matters more than prediction. Prediction is fragile, preparation compounds. Prediction makes you feel special, preparation makes you money. And over the next decade, a lot of fortunes are going to be built not by people who guessed the next headline, but by people who learned how to behave while headlines were screaming. That is the real opportunity. Not the war, not the panic, the discount created by both. And the crowd, as usual, is trying its hardest to run away from it.